think we're under a period of fiscal dominance. So I think that the large fiscal deficits are stimulatory in a way. That stimulation comes with consequences, but nonetheless, it's a type of stimulation. And so you have kind of a K-shaped economy, which is there are certain segments that are doing very poorly, especially lower income consumers. A lot of the metrics there aren't good, whereas a lot of the upper end consumption is still holding up strong. A lot of that is fueled by these fiscal deficits. And so I think you have to kind of look at that on an industry by industry basis. And there's like this next quarter or so, there is a pretty significant window of vulnerability because of the tariffs. There are a lot of businesses that are in a period of indecision. And I generally fade some of the most negative takes on that. But I do think that it is pretty clear that there is kind of a slowdown in industry until there's more clarity. I've kind of popularized the term "nothing stops the train" to refer to the long-term outlook of fiscal deficits. I generally place very low probabilities that no matter who is elected and how things are run, that anyone's going to get the deficit down in the next 5-10 years. A lot of it is demographics driven. A lot of it is a Gordian knot of financialization that has occurred over decades. And so I think this is just an expected outcome of that. I think that a lot of people got caught up on the idea that there might be some sort of fiscal consolidation. I've generally been fading that notion, and this has implications for kind of running the economy hot. We've also seen, earlier on, Treasury Secretary Scott Bessent was talking about prioritizing getting yields lower on the 10-year and elsewhere on the curve. Whereas now he's more talking about, instead of deficit reduction, he's talking about basically making sure nominal GDP runs hot enough to keep the debt to GDP ratio in line. I don't really doubt that they're going to be able to do that. I think that's actually a likely thing of happening. It's possible that the debt to GDP ratio could keep inching up, but I think that the nominal GDP growth is going to be substantial. Whether it's inflation, whether it's real growth is, yet to be seen. But basically we have this kind of recursive function there where the deficits are stimulatory, inflationary, and keeps things kind of going for a while. Their promises in their campaign were focused on Medicare and Social Security, whereas Medicaid is more of the programs for those that can't afford it, whereas Medicare is more of the program for the elderly. And so the ones that they can't really touch and they promise not to touch are those ones more towards seniors. I'm not surprised to see that trim in the grand scheme of things. Now, when people hear $1 trillion, it's important to keep in mind that's spread over a long period of time. That's not like $1 trillion a year. That's $1 trillion spread over several years. There are cuts that matter to people in that, but in the grand scheme of things, the overall net effect is ongoing big deficits. And it's important to kind of pay attention to where those deficits are going. So yeah, we'll see a little bit less toward Medicaid and we'll see, more elsewhere. But in the macro thing, it's kind of about the big numbers that really matter. And because they're not going after the really big things in the room, which is Medicare, Social Security, defense, can't do much about interest expense, veterans benefits, that big chunk right there is the vast majority of government spending. So they're kind of playing with the much smaller sections of the pie, which is pretty much everything else. It's the FAA, it's parks, it's, Homeland Security, all sorts of stuff like that. That's the long tail of stuff that they've been trying to target with these little cuts here and there. And most of those are optical wins. That's not where the big money is. And there's really no political will to go after where the big money is. I think we're kind of in a choppy range for quite a while. We'll see how high we get. The 10-year is still not at the top of the cycle that it's been in this period. And they have a lot of tools that they can do. Some of those get pretty extreme. They can do outright yield curve control if they have actual crises. There's also been wonky things. Under Treasury Secretary Yellen, they've been issuing more T-bills to try to avoid flooding the market with too much long duration. And that's something that the current Treasury Secretary, Scott Bessent, kind of vowed to unwind. I think he's going to have trouble doing that because imagine seeing these yields and say, well, now we're going to issue even more supply on the longer end of the curve. And that's just hard to do, hard to stomach. And so I kind of fade the notion that it's just going to spike up really high. But I do think it's going to be range bound and we're not going to see lower lows in the future. So whether we chop between 3 and 6% for the 10-year, I don't really know exactly where it's going to end up. But basically, the bond market's realizing that there's really no end to these deficits. And so they need higher yields to compensate. And probably by this time next year, we'll be back in the Fed gradually increasing their balance sheet. They might not want to call it QE because they might, for example, focusing on buying the shorter end of the curve. I just go back to gradual balance sheet increases like that for what they would consider technical reasons. And there's other tools they can do. They can do SLR changes so they can make it easier for banks to buy treasuries. So they still have levers they can pull, but basically it's just not a market I want to own. Whether you're bearish in it in the nominal sense, like that yields are going to go up, or that yields are just going to be chopping along for a while and doing worse than scarcer assets. If I'm getting paid 4.5% on, a bond, and money supply is increasing historically at 7% a year and probably going to keep going up at a similar or faster rate, that's long-term dilution. So when I look at other assets I could own, bonds are still not really near the top of the list. Now, I do think that there are certain segments that are interesting, like tips are getting pretty interesting. If someone's kind of entering retirement years, looking for lower volatility ways to kind of lock in some of their purchasing power, I'm not sure that tips are fully capable of making that promise because there's wonky things around inflation calculations and things like that. But I do think that the real yields are pretty interesting at these levels and that they can make sense for part of a portfolio. So I don't fade the entire bond market, but I do think that we're kind of in a structural period of bonds just not being great assets across the board. Well, I think at this level, the dollar is still overvalued. If you look at the dollar over the past 50 plus years, so ever since the early 1970s, it's only gone through 3 major cycles. So there's been 3 major bull markets in the dollar, and there's been 2 major bear markets because we're still in kind of the third dollar bull market, meaning that from 2014 to the present, it's been in a pretty strong dollar environment, meaning it's squeezing emerging markets and their dollar-denominated debt. It's worsening the U.S. trade deficit. If you look at, for example, the Big Mac Index or other measures of purchasing power parity, the current dollar level is quite expensive, whereas, for example, the yen is on the cheaper side of things. And I kind of expect we're going to chop around for a period of time. The U.S. still has a pretty big interest rate differential with Europe, for example, and the euro is a really big part of the DXY basket of comparison. Similar thing, we have a pretty big yield differential between the U.S. dollar and yen. And so I don't necessarily expect us to rapidly drop from here. A lot of that was just kind of unwinding that pretty quick move from 100 to 110, and we kind of just round tripped a lot of that. I wouldn't be surprised to see a 20+% drop in the dollar compared to other currencies. It's just not necessarily something I'm looking forward to in the next 3 to 6 months. I think it probably needs to settle for a bit, and then maybe we'll look into lower lows. So I don't mind equal weight S&P 500. I'm a little aware of the big concentration in some of the biggest stocks. And I do think that foreign equities are more interesting at the current time, but I do have a broad swath of equities in my portfolio. Generally, what I expect is probably multiple years of chop, which is we could very well hit new nominal highs depending on what inflation ends up being. But I think that the return profile that people got over the past 40 plus years of ever falling interest rates, ever higher stock valuations, I think that period is behind us. And that, while there are plenty of good investments out there, the S&P 500 could certainly hit new highs. I think it's going to be just more lackluster. I think that the fiscal dominance does a lot to prevent major drawdowns. It's pretty hard to kind of rapidly drop in asset prices when you're running sustained deficits and monetization of this scale. But, you can certainly drop for 20+% for a period of time, but then it finds a floor and then kind of keeps grinding up. So I think that we're in a period of weaker real returns for the foreseeable future until we work out some of the valuation excess or until we enter maybe a new market regime. So I'm neither particularly bearish nor particularly bullish, but there are pockets of the world that I'm more bullish on. And there are certain emerging markets that are super cheap. And this is kind of their first window of potential outperformance for quite a while. It's been a losing trade to bet against the large US growth stocks and to really be anywhere else in the world. And I think this is a pretty good window to reverse that. I'm not 100% sure that's going to happen, but I think the probabilities are higher than they have been for quite a while. There's 2 major branches of uncertainty right now. There's obviously the whole tariff situation, and then there's AI as well. So rapid technological change creates uncertainty, and so does political uncertainty. And one of the biggest disconnects you see is high uncertainty, but also high valuations. High valuations on equities generally imply low uncertainty. People are willing to pay up when they have a very high conviction of what's going to happen with earnings and growth over the next 5-10 years. And so as an investor, I don't really mind uncertainty as long as I feel like I'm getting paid for it. Where I get concerned is where I don't see like I'm getting paid for it. And there are pockets of the US stock market. I think Walmart and Costco are quite expensive given the level of uncertainty around them. If we look 10 years from now, I think Costco is going to be bigger and more successful than ever, but there's a limit to what I'm willing to pay valuation wise for that view. So I'm kind of bullish on the company, but bearish on the stock in kind of real terms. And I think that's a story among some of the big tech stocks. That's a story among some of the big kind of low types of large US growth stocks that have pretty low volatility of their earnings. So investors want that certainty. And I think that they're overpaying for that certainty at the current time. So I'm more comfortable in, for example, US banks that have higher uncertainty, but that's already priced in. That's not a very crowded space, which is why I find it interesting. So both as an economic participant, I think there's a lot of uncertainty, and as an investor, I think there's a lot of uncertainty, and it really comes down to pricing. I generally find Brazil interesting at the current time, kind of Latin America broadly. China is interesting. A year ago, that was considered uninvestable. It's very cheap. It's kind of slowly coming out of a rut. I think that their priorities shifted. They kind of hit a low point in what they're willing to accept in their economy last year. And now they're more into supporting around the margin what households are doing there. And some of the Eastern European markets are interesting. Other parts of Southeast Asia are interesting. I think that whole trading block is pretty interesting. But basically, it's more of a broad play. So there's no particular one market that I'm kind of pounding the table on, but I do like diverse exposure to a lot of them because what they share in common is they're relatively cheap. A lot of them have decent reserves relative to their dollar debt, so they're at lower risk of currency crises than we're normally thinking of in terms of emerging markets. And so I think that they could very well have a good 3 to 5 year cycle.